Hello, everyone. Welcome back to Signal or Noise, episode 32. Charlie Bilello here. Peter Mallouk, of course, joining me as well. What are we going to be discussing today? A lot of interesting topics. The elephant in the room, Peter. Here we go again with national debt. We hit another milestone. It's going to be a fun one to break that down. No taxes on tips and Social Security. Those are two proposals being floated as we approach the election. 3, how to manage a concentrated stock position. This is an important one, particularly after the last decade and the strong returns we've seen in a number of tech stocks. So we'll break that down, some of the different options that investors have. Number 4, your schedule doesn't lie. You put out this tweet. I thought it was sent a great message. So we'll talk about that. And we'll end, as we always do, with Signal or Noise. Been a little bit of an interesting past week, Peter, since we did the last episode with the VIX. Was above 65 when we were recording it last Monday, and I'll reveal where it is today. Just a stunning move, something we actually have never seen before in history in terms of the volatility of volatility. Okay, so let's start out with the elephant in the room that keeps growing. Why do I call it the elephant in the room? Because really no one still isn't talking about it. If you listen to the number 1, number 2, number 3 issues heading into the election, this simply isn't there. And the average, I think, weight of an elephant's around 12,000 pounds. And now we're way above that and still no one's talking about it, Peter. And here we go. 35 trillion in national debt. Every trillion, you and I break this down. And here we are, August 2024, 35 trillion in national debt. And let me just show you what we have done since that debt ceiling was lifted. You and I did this show back then saying, of course, it's going to be lifted, because we're spending way more than we're taking in. So you cannot have a limit. And boy, did that prove to be true. We've increased the national debt by 3.6 trillion in the 14 months since that debt ceiling was lifted. And over the last 5 years, a 59% increase in the national debt, moving from 22 trillion back in 2019 to over 35 trillion today. Peter, your thoughts on the U.S. national debt, and why is nobody talking about it?
So my take on most things is, hey, this doesn't matter as much as you think it does, and this is overblown, and don't get caught up in the media narrative and all of that. The national debt of the United States is the single biggest threat to the United States economy. It's the single biggest threat to investors. It's literally the single biggest threat to Western civilization, ahead of nuclear weapons. I mean, that's how big of a deal the national debt is. I think the reason it doesn't get any attention is because voters care about what they feel impacts them now. You know, are my tips going to be taxed? Is my Social Security going to be taxed? Is my interest rate on my house going to go down? Can I afford a house? We're thinking about these things where there's a direct, is my student loan going to be forgiven? Am I going to get a forgivable loan for my business? All of these things, like, people get it and how it impacts them now. This is like credit card debt, but every single month we add credit card debt. The household adds credit card debt, but there's no consequence. So, of course, the next person who gets the credit card for that 4 years is going to keep spending because someone else is going to deal with the crisis. But there will be a crisis. I would put this in the very, very big deal with bold neon letters category.
Okay, so if we look at this in terms of, this is the big debate always, well, is it a spending problem or is it a revenue problem? Do we need simply to tax people more, or do we need to cut?
It's a spending problem, obviously, right?
It's okay.
Right.
And I think the data clearly bears that out. If we look at tax revenue, I was looking at it just before we started the video, and tax revenue over the last 5 years is up over 40%. So we're bringing in over 40% more. But even with that, we've expanded the national debt 59%. That just tells you how much more we've increased spending. And here what I'm showing you is spending as a percent of GDP by decade. And you can see in the 1950s, we're at 17%, 60s, 18%. Then we were hovering around 21, 22, 23%. It got up to in the 2010s. And so far in the 2020s, we're talking about 27% of GDP. Of course, a lot of that came during the COVID stimulus era. But the fascinating thing to me, Peter, is even after the crisis there, was over, even after we were clearly in an economic expansion, and now we've been in one for over 4 years, the spending continued. And that's kind of disheartening because, as we know, there will be another recession at some point. And what are we going to do when that happens? What's going to happen to the national debt at that point in time? I think you and I can probably agree it's going to likely go much, much higher. So is there any way to get this spending under control? Or is it simply the case that politicians are going to continue to promise spending more because that's what gets them elected? And if we look at the 2020 election, it was all about who's going to give a bigger stimulus in terms of, is it going to be the Republicans or the Democrat? And this time around, we're seeing those same types of promises being thrown around.
If you want to look at the outcome of any political decision, you just look at the incentives, right? And the incentives will drive the behavior. And if you're the president of the United States, doesn't matter if you're a Democrat or Republican, because you're going to spend, it's just a question of what you're going to spend it on, right? If you can spend, you get a reward for spending. You get a reward for spending on different things. What's the penalty? Well, the answer is there is no penalty for you, right? While you're sitting in office, the penalty is going to be borne by somebody in the future. And so I don't see a solution here. The only potential path is you get a very bipartisan effort to come up with some controls, like spending can't go over this amount without these things happening. It's almost impossible to visualize. And I think we're going to deal with this the way we deal with everything else in a democracy. Will have to become an absolute crisis, because in that situation, the president does have something to lose by allowing everything to fall apart, and they have something to gain by saving the day, right? So that president who's facing that existential crisis is going to be able to have the ability to maybe right the ship. It's the same with Social Security, right? There's no incentive for anybody to solve this problem, which is very solvable, unless people feel like it's so bad that they won't get Social Security. That president and Congress would be able to do what they need to do to save, they'd be heroes for saving the program, even if they have to do some things that would have been unheard of years before. And I think that's how this will be dealt with.
That makes sense. But when I think about, in terms of blame and in terms of they have to feel that pain for the politicians, why aren't people making the connection between the highest inflation rate that we've seen since the early 1980s and this type of spending, this increase in debt, this deficit spending? Why aren't they connecting the two and saying, well, we don't want a return to that? They seem to be very angry about inflation, but nobody seems to be saying, oh, let's pull back in terms of spending to make sure we don't have another period of super high inflation in
Well,
the
these
future.
are very different things. Like inflation, someone goes to the supermarket, they understand inflation and how it impacts their household. Or you try to buy a car, you try to build a house. No one knows what the hell's going on with the deficit, but like you and like 22 other people in the United States, right? So politics is local. The decisions you care about are the things that affect you. That's just how it is, right? And so people are very in tune with inflation, how to control it. If you sat down with your 10 closest friends and ask them to write down the 10 issues they're most concerned about, this probably, well, maybe the crowd you hang out with, this would make their list, but the crowd I hang out with, no one is going to name this in their top 10 things that they're thinking about.
So they're not talking about the money supply and all of that stuff. Okay.
No.
I get it. So
Yeah.
I guess the connection has to be made for someone to do something about this, to say, look, do you want to have this high inflation in the future? If so, continue on the same path. If you don't, then we should really try to do something different before it becomes a crisis. But agree with you in the sense that the average person isn't feeling the pain of this yet, and the government isn't feeling the pain because, pretty simply, we're borrowing to pay that interest. So we're now over $1 trillion in terms of the interest on the national debt. You say, where is that money coming from? Well, we're simply adding to the national debt to pay more in interest. So this is kind of a spiral, Peter. I mean, I guess if we cut interest rates to zero, this would help this chart. And certainly there are going to be interest rate cuts. So maybe this will slow down in terms of increasing, but that debt pile is still going higher and higher. So unless interest rates decline meaningfully, this is going to become more and more an issue. So my prediction, Peter, is we'll be talking about 36 trillion at some point, probably in early 2025. And what we'll be saying at that time is we're getting closer, but still not at the point where it's a crisis. So I'm showing you here the federal government's interest payments as a percentage of GDP. And we're at the highest level since 1998, 3.8%. But when I show this to people, and I've shown this chart today, they said, well, it's been 5% in the past. So why do we have to worry yet? And so I think that is kind of the consensus, that we're just not there yet. And as a country, we don't respond to things that may be a problem in the future. We respond to things that are a problem today. Okay. So look forward to talking about 36 trillion in a future episode. Peter, on interesting here that we have this issue with national debt, we have this issue with the fiscal deficits, and yet what are the candidates proposing here? Well, things that will likely add to that debt, add to those deficits. Here are two things Trump and Harris agree on. They don't seem to agree on very much, but one thing they seem to agree on is they both want to eliminate taxes on tips. And Trump has also floated to ending taxes on Social Security benefits. Let's break this down one by one. First, tell me your thoughts on eliminating taxes on tips.
Well, I mean, what a popular thing to say. As you know, most people that are collecting tips are not paying federal, taxes in the first place. So I mean, in reality, I'm not sure how much of an impact it has. I do think it's unfair to. There's a ton of people that have minimum wage jobs that are not associated with tips, and so it really doesn't treat those two groups fairly. And I'm not a fan of things that don't treat groups fairly. I think that I like the idea that people with low incomes pay close to zero in taxes anyway. That's what should be happening. But having one group that's being paid minimum wage be taxed in a different way than another group that just happens to be paid a different way, not very fair. Your take?
Yeah, from fairness standpoint, it doesn't seem to make any sense, and no one's really talking about that other group, which is the vast majority. You're looking at the lowest quartile of workers. Only 5% of them are in jobs that receive tips. 95% are in jobs that don't. So why should someone who works at a restaurant as a waiter or waitress receive this benefit while someone who works as a cashier in a supermarket doesn't? To me, that makes absolutely no sense. If you want to help these people, if you're saying you want to help lower income people, which is what they're essentially saying here, do it by raising the standard deduction,
That's right.
increasing
Yeah.
child tax care credits. There's a lot of other ways you can do it that would be broadly applied regardless of what industry you're in. And to me, the other thing, Peter, that we didn't discuss yet is when you create a new law, something like this, you create a loophole, people are going to change the way they're compensated. Obviously, if there was a portion of your income that's not going to be taxed, you're going to tell your employer, let me get paid more in tips. You could see like any type of service jobs where people will be just making an agreement with their customers to say, don't pay me hourly or pay me a lump sum, just tip me what you think is worthwhile, and let's just call it a tip, and we'll
Right.
do a handshake deal, and
Yeah.
that's better for me, better for you, and we just avoid the tax. So of course, and I'm sure there's going to be some income limits on this type of things, but of course there's going to be that segment of the population that's going to try to game the system, and rightfully so, to say, well, why shouldn't I get this tax-free income?
100%. It'll be very interesting to see where this goes, given both parties are advocating for this now.
So yeah, I guess it comes down to it's a popularity contest, and same thing when you were running for office in junior high, you would promise free cookies or something free. It's a
Longer
similar
resort.
thing here, and I guess are the other workers going to be as vocally against this as the people who receive tips are in favor of it? I don't know. I haven't. I guess I haven't heard that just yet, but maybe that's out there. But like you said, it's both parties, so I guess there seems to be broad appeal for this. I just the mechanics of it to me makes absolutely no sense, and it's 100% not fair. Okay, let's move over to Social Security. But just one last point on that: what you were saying, most of these people don't pay federal income tax already. That's absolutely true. If you look at the bottom 50,000 in terms of income, they actually have a negative tax rate because they're receiving some of the credits as well. So this is the idea that this is saving lower income people taxes when half of the country already doesn't pay federal income tax doesn't make sense. All right, let's discuss Social Security, Peter. This is a something that affects obviously a big segment of the population, and I'd say more so the voting segment of the population. So yeah, a lot of more younger workers are in those industries that receive tips, and I'm sure yes they'll be motivated to vote for that type of policy, but way more older people receiving Social Security are voters in this country. And what do you make of the idea that they shouldn't stop paying federal income tax on that Social Security income?
Well, I mean, this is like from a purely political standpoint, this is the thing you would want to advocate for because these are the people that are most likely to go to the polls. From a fiscal responsibility standpoint, this is the single craziest economic proposal that's on the table right now. You've got two systems that are a mess: Social Security and the national debt and deficit. And this actually exacerbates the two biggest financial issues we have at present. So, like from an economic responsibility standpoint, not positive.
Yeah, so people probably don't know, but the taxes on your Social Security actually go directly into that Social Security trust fund, and as we've talked about, that's being depleted every year. It's likely to run out in 10 years, and they're saying if these proposals were approved in terms of not taxing Social Security, that would speed up that process of that money running out. So it's very popular, but again, it's going to force that crisis to come sooner. And here's the other thing, Peter. Again, coming back to in terms of fairness, again, if you're saying that you're trying to help lower income people who are receiving these benefits, 60% of people don't pay any tax on their Social Security because they make too little. So if you don't have other income and all you have is Social Security income, you're likely not paying any federal income tax on that already. So it's really about the people making higher incomes. They have other investment income or some self-employment income or interest income that will get the big benefit, and that of course would be the wealthiest segment of the country. So this is kind of a fascinating thing. So we're selling that seniors need help, but if you look at the net worth in the US by age group, clearly the baby boomers are number one, and you could see the disparity in terms of Gen X and millennials, much lower net worth. So again, in the terms of fairness, if you're trying to actually help the group that needs it most, this seems to be doing actually the exact opposite of that.
100%, like going the wrong direction.
All right, so we'll revisit this in a few months. We'll see if these things get passed, and we'll just have to see if
Yeah,
people
I'm putting that Social Security one at 1% chance of
I
that.
think it's much lower. Yeah,
Yeah,
I think yeah, I would agree with that because they're going to frame this argument like I'm
right.
showing here that it's
Yeah.
helping wealthier Americans, and again, it's from a fairness standpoint. Does that make sense? Okay. Number three, Peter, this is a big issue for a lot of our clients. People come to us because of our expertise in this area, how to manage a concentrated stock position. Just want to walk through a couple of the ways that people end up with such a position. Number one, company stock. You have it in your compensation plan, or you're able to buy it at a discount. A lot of different ways, but that would be one way. You could inherit it. You could obviously sell your business, and you could have number four, just tremendous growth in a particular stock. Apple, Amazon, and of course, Nvidia being the number one example of late best performing stock over the last 30 years. If you invested $10,000 at Nvidia's IPO in 1999, that's worth 32 million today. And this was a crazy stat. They did a poll of Nvidia employees, and over three-quarters of them had a net worth above a million, and 36% had a net worth of over 20 million, which is an unbelievable stat to me. So in terms of holding a concentrated stock, we know the downside, right? There you have the risk to that particular security, that asset class. Yeah, it's going to be more volatile, and of course you have the tail risk of if it goes bankrupt, then you lose everything. But oftentimes it's not that simple. If you come to us with this huge position, there's other things that you have to consider. There's emotions involved. So really, there's a number of choices that investors can choose from. They can hold, they can sell, they can donate, they can diversify. Break me down how you think about this with a client. If someone came to you, let's say that NVIDIA example, they have $40 million now in NVIDIA stock. It's over 99% of their net worth. How do you break down understanding, first of all, everything about them, and then trying to educate them and help them understand their different options?
Well, NVIDIA is a great example, but because we're seeing that specific example more than anything else right now. I also think it's interesting. NVIDIA can't hold their employees anymore because they're all so wealthy. Their average engineer has 10 million plus dollars. They're all leaving. And so it's going to be interesting to see how they deal with that talent drain given the enormous success of their stock. Well, so look, when I'm sitting with somebody who's got a bunch of money in one stock, I walk them through all their options. Number one, you can hold, right? Sometimes people tell you, oh, sell the whole thing, diversify. Like, you're an adult. If you want to hold it, obviously that's a decision you can make. You just need to really understand the risks, because everyone looks at that stock that's become a very big part of their portfolio, and all they know is this is the greatest single success they've ever had, better than anything else. So you're going to show up and tell them this is the biggest risk you have? That doesn't really, there's a lot of cognitive dissonance that'll happen there. And so people really struggle with that idea, but holding is an option. The other option that I think surprises people is you don't need to have fancy tax strategies. There's a lot of people that just say, I'm just going to sell. I'm literally going to hit a button. I'm going to sell and I'm going to pay my taxes. Now, what's the logic of that? The logic is the capital gains rate is the lowest it's been in a long time. And it will probably only be higher for the rest of our lives. So a lot of people go, you know what? Capital gains rate federally is 20%. If you're in a state that pays no taxes, a lot of people just say, you know what? I'm just going to sell and be done with it. If you're in a higher state tax like California, New York, probably not in love with this just sell idea. The next thing you can do is you can donate. 91% of charitable giving is with cash. Cash is the worst thing you can give to a charity. You get an income tax deduction when you give to charity, but you also can give away appreciated assets and escape the capital gains tax. So let's take that NVIDIA person. He's got $10 million in NVIDIA stock, but over the rest of his life, he's going to give $2 million to charity. Well, we can give that $2 million of NVIDIA stock directly to the charity, and he will get an income tax deduction, plus the charity will sell the NVIDIA stock and pay no capital gains taxes. So he's escaped the capital gains taxes. If he doesn't want to give to the charity now, he can set up his own foundation. We would set up a foundation for this person, whether it's a public or private foundation. He can donate the NVIDIA stock to that foundation, get the income tax deduction, and avoid the capital gains taxes today, and in the future, distribute money to the charities. Sometimes people need the income themselves but want to help charity in the future. You can set up a charitable trust. You transfer the NVIDIA stock, in this example, NVIDIA stock to the charitable trust. Let's say you move $10 million there. The charitable trust can sell it and pay no taxes at all. And you can collect income from that trust. Let's say it's 8% for the rest of your life. So this person's getting $800,000 a year coming in for the rest of his life. What's the catch? Because there was an income tax deduction, you paid no capital gains taxes. The catch is on your death, that money has to go to a charity. Oh, and that charity can even be your own charity. It can be your own foundation. So you contrast that with the person who says, okay, I'm going to sell 10 million of NVIDIA stock. I'm going to wind up with 7 million after taxes. I'll live off the income of 7 million, versus the person who gives the 10 million to a charitable trust, sells it, still has 10 million, and is living off the income of 10 million, which is obviously more than the income of 7 million. The catch being it goes to charity on death. Like, there's a lot of ideas, and you can go on and on about that. There are funds you can put your stock in and get diversified stock back from that. Some people
Yep.
borrow against their investment account and diversify around the position doing that. Some people sell part of their position and tax harvest aggressively throughout the year to offset the taxes. But here's how I coach, people that come to me with this, which is all the time, right? I basically tell them, like, look, let's figure out what you need to be independent for the rest of your life, and let's not mess around with that. Why don't we diversify enough for you to be independent for the rest of your life? Wouldn't that be wonderful? And then the rest, let's do whatever you want, right? You want to hold it, you want to sell it, you want to diversify some of it, you want to unwind it over time. But normally there's not one answer. Normally the answer is you do a plan, you figure out what you need over the short run and the long run, you figure how much you should diversify to be independent for a few generations, you make the smartest moves possible to do that. You maybe at the same time, maybe you're somewhat charitable, but not overwhelmingly charitable. We do some charitable planning as well. And you're putting some of these pieces together. So it's very, very common for a client to do multiple things to get where they need to be.
Yeah, that makes sense. Often a one size fits all approach isn't going to work, especially in this type of example. I like that idea of saying, well, how much do you need to be independent? Because then it's all upside from there. And you
Right.
really, all of this is talking about that tail downside risk. And to just take that off the table, that worry of NVIDIA, let's say going down 50, 60, 70, 80%, take that off the table where it doesn't matter because you've already cashed out that portion to create independence. The tax thing is an interesting one, Peter, because as you know, Warren Buffett sold a lot of Apple stock in the last quarter, and a lot of people are talking about the reasons why. And he said back in May, one of those reasons is because he expects capital gains tax rates and corporate tax rates to be much higher going forward than they are today. So why not? He has this huge gain in Apple. I think it's almost a 10x from where they bought it back in 2016. Why not pay that tax today rather than waiting for corporate tax rates to go back up to high 20s or 30%?
Right. Yeah. I'm not sure I buy his argument. I remember him saying that, but I agree with him that corporate rates are going to go up, capital gains rates are going to go up. Not sure that's the reason he sold his Apple stock. That logic would apply to any stock in his portfolio.
Yeah, agreed. My view, as you know, is that it's more of a valuation thing,
That's
and
right. Yeah.
if the greatest value investor of all time sees a stock trading at 9 times sales and 30 times earnings when he bought it at 10 times earnings and 2 times sales, I think that's going to have a little bit of an impact
Yes.
on the decision making process. Okay. At Creative Planning, we really combine everything to try to help you answer this question. We have advisory services, obviously, but we have tax planning, estate planning, and this is the type of question we get all the time. And we likely have done hundreds or thousands of situations similar to you. So reach out to us today, creativeplanning.com/Charlie, to get a free wealth path analysis. We'll look at all of your portfolio positions. And if you have a concentrated position, we'll walk you through all the different options of what you can do and really the optimal strategy from a tax standpoint, from an estate planning standpoint, and from a portfolio standpoint in terms of diversifying your portfolio. So reach out today. We have over 300 billion in assets under management and advisement. We're in all 50 states, so we likely have a location right near you, and we're here to help. So creativeplanning.com/Charlie. Set up a call or a meeting with an advisor today to get a free wealth path analysis. Okay, Peter, I want to touch on scheduling. And you had this tweet talking about your schedule doesn't lie. Is this a book that you were reading, or you found this from someone else?
That one was somewhere else, but I love it
Okay.
because the saying I've always, a saying that I've heard and I've tried to live by the best I can is, it doesn't matter what anyone tells you about what's important to them. There's two ways to tell. It's their calendar and their checkbook, right? Your calendar and your checkbook really tell what you value. And so I've always been a very, very big believer on that. Every Sunday I look at my calendar going forward for the week and the month and ask myself, is this aligned with what I really care about, what I'm really trying to do? And so this really resonated with me.
Yeah, so let me just read it for those that are listening here. There's an old phrase that says, "What you're doing speaks so loudly I cannot hear what you're saying." You can say that your primary value involves putting your family first, but if time with your family is not all over your schedule, well, then the truth of the matter is your family life isn't your priority. Now, you talk to a lot of people who have created financial independence, and often the focus from an advisory standpoint is on asset allocation. How do you position your assets? What percent should you have in stocks, bonds, real estate, etc.? But do you often spend also time talking about time allocations? Really, the one resource that you can't create more of. You can't go back in time. Once it's gone, and just helping people understand that who have already achieved financial independence, and then you see their schedule isn't reflecting their values and their goals. Is that part of the conversation sometimes as well with people?
I mean, I think that it's impossible to listen to if you creative planning clients between our annual meetings and our letters. And in all four books I've written, I talk about the importance of time, the importance of enjoying your money. the Down the Middle podcast I do with Jonathan Clements every month. I'd say every couple episodes, we talk about the importance of enjoying your money, enjoying your wealth. And you and I did a whole podcast that ended, with kind of the "Here Comes the Sun," talking about
Yep.
the importance of enjoying your time. I very, very early in my career saw that the traits of success usually involve hard work and diligence and putting money away. And those same people really struggle to then flip and take the money out and really enjoy themselves and enjoy their families and all those things. And we all make excuses, right? Well, I'm trying to save up money for my kids. Well, if you've got money, don't make it be an inheritance. Enjoy giving it to them now. Or they say, "Oh, I want a big pile of money so that when I die, they help all these charities." Well, it's better to give with a warm hand than the cold one. Give now, enjoy giving now. The reality is it's just hard for some people to shift, but we all think we've got forever. Even at creative planning, when we run retirement projections, we say, okay, well, we're going to assume you live till 100, because a lot of people are going to live till 100 and beyond, and we don't want anybody to run out of money. But the reality is, let's take a married couple. If one of them becomes not totally mobile, that changes completely what you can do, right? And so there are these windows we have to really enjoy ourselves, and I always encourage clients to enjoy themselves. Part of running these projections with clients isn't to figure out if they're independent. A lot of people, they don't need me to run a projection for them to tell them they're independent. It's to figure out how much extra money they have that they should really be going out of their way to enjoy right now. I'm a very, very big believer in this. And I think it's very hard. It's just it's not a natural bias of the majority of successful people. And
So
so
you're
it's
essentially, yeah, you're
thanks, Doug.
giving them permission, is what you
Yeah.
like, and as an advisor, and I think that's okay to do that. Right? They've done all the work all along. Now you're giving them permission
Yeah.
to enjoy it.
And the permission's sometimes not enough. It needs to come with encouragement. Right? The two need to
Yeah,
come together.
sure, 100%. Okay, we'll end as we always do, Peter, here with signal or noise, and a lot of times nothing happens in the markets. That has not been the case over the past week. You and I recorded a show last Monday, what some people were calling Black Monday at the
Right.
time, in the morning at least. And when we recorded it, the VIX was over 65, and I was saying that was kind of unbelievable to me because the S&P was only down 3 or 4% futures, and what we said at the time is like unless there's just an absolute crash from here, it's likely to go lower. But what I didn't expect is it to go this much lower this fast, and actually closed at 18 yesterday, one of the biggest short-term declines in the VIX ever. And if we look at 6 days, it was the biggest decline ever. But I just want to revisit here the two sides of volatility that we've experienced over the past few weeks. First, we had that upside spike in volatility, where it was the third biggest spike in the VIX ever. If we're looking at 3 day spikes, 136% increase. And we talked a little bit about this on the last show, but volatility, forget about the short term, but even the short term, it tends to be a better time to buy when you have these types of panics. But in the long run, it almost always is a better time for a long term investor to buy. And so far, that's actually been the case. I know it's only been a week, but we've had
Right.
a tremendous bounce here in the stock market. The S&P's up 6%, NASDAQ 109%, NVIDIA 28% since the lows on that August 5th time period. Did you have, I know you were meeting with clients that day, did you have anybody talking about it or thinking of panicking that day? And hopefully not, but
Yeah, I think
how did those conversations go?
a creative planning client's not panicking that day, but it was amazing to see how quickly certain asset classes, started to crumble, and big tech, how hard it got hit, and the resiliency. I mean, as you show on this chart, just a stunning 10-day period of time.
Yeah, by the dip they did. And the crazy thing is that we saw, and this is mean reverting, right? That's the number one thing with volatility. When it spikes, it's very likely to come back down. The historical average for the VIX is around 20. We're actually below that now, which is kind of incredible given where we were last week. But we're now looking at the biggest 6 day decline ever, down 53%. So again, people are asking me, well, is this the same as a volatility spike? And my answer is not the same. It's always better to be a buyer when there's a panic, when there's fear, but there's nothing in the data set that I can show you here looking at a year, 2 years, 3 years now from now to say that a big move lower in the VIX, so coming back after a spike, is necessarily a bearish signal. Like it's the a downward move in the VIX seems to be noise, an upward spike in the VIX seems to be a signal. Is that the way you kind of interpret it?
I think you nailed it last time when you said the exact same thing, and it's played out.
Okay. So we'll see what happens from here. It's been an exciting couple of weeks in the markets. And if you're a long term investor and you're adding to your 401k IRA every couple of weeks, you don't want to shut that off during periods of panic because it's actually a better long term position to buy in. And what we're seeing in the past few weeks is perfectly normal. 5 to 10% correction happens a few times a year on average. And this is just the latest example. There will definitely be more. And nobody can tell you, this is the important point. No one can tell you what will happen from here. If we're going to race right back to new all time highs, that wouldn't surprise me. If we went back down to a lower low, that wouldn't surprise. Nothing should surprise you in the short term. Just as an investor, view periods of panic as opportunities if you have a long time horizon, regardless of what happens in the short run. Okay, Peter, we'll end it right there. If you're watching this on YouTube, take a moment, hit that subscribe button, hit that like button, leave a comment. I read all the comments and try to respond to as many as possible. Thanks everyone for joining us, and we'll see you next time on Signal or Noise.